Ever heard people say it's impossible to beat the market and then struggle to give some random explanation for how Warren Buffett was able to do so? Oh, he was just lucky. Well, I think it's untrue and I think you can beat the market. So today I want to give you 5 main reasons why I think it's possible and hopefully debunk the myth. When I talk about beating the market, of course, I mean beating the S&P 500 over any certain period of time in returns. And what passive investors usually say when they refer to active management as being pointless and useless is how most large actively managed funds cannot beat the S&P 500 over any period of time. 80% lose out over a 5-year period and 92% lose out over a 10-year period. So if these highly paid professional investors can't beat the market, what hope do you have? Well, that's one of the things that I want to push back on the hardest today. So without further ado, reason number 1.
Consultants got every motivation in the world to tell you this year I think we should concentrate more on international stocks, or this year this manager's particularly good on the short side. And so they come in and they talk for hours and you pay them a large fee, and they always suggest something other than just sitting on your rear end and participating in American business without cost.
Actively managed funds are not designed to beat the market, believe it or not. They're effectively just marketing tools which are designed to bring in more assets under management or preserve the assets already under management there. For example, if there is a downturn, these funds will be forced to make a move into safer assets to appease their investors rather than invest in very cheap stocks which are still falling. In contrast, when the market is in a bull market, they may be forced to buy overvalued stocks because their investors have heard about them and it brings in more assets under management if they're shown to be invested in them. That means they're not investing in stocks because they're a value proposition, but because they bring in more assets under management. You as an individual investor don't have to do that. When the market goes down, you can buy undervalued stocks. And when the market goes up, you can still buy undervalued stocks. Hedge funds and active funds aren't allowed to do that, and that's a massive reason why you can actually beat them.
He mentioned that Apple is now 35% of Berkshire's portfolio and thinks that that is near a danger zone. Wonders if Warren and Charlie can comment.
I'd like to make one comment first, but Charlie will come up with.
I think he's out of his mind. It's not that easy to have a vast plethora of good opportunities that are easily identified. And if you've only got 3, I'd rather be in my best ideas instead of my worst.
Number 2, concentration. If you're an individual investor, you can keep whatever percentage of your portfolio as whatever stock you like. If you are a really big believer in the Apple story and their financials, you can have them as a third of your portfolio. Whereas if you're an actively managed fund, they usually have limits on how much of their portfolio can be one specific stock. That's usually 5 or even 10% sometimes. If one of your stocks performs so well that they go above that threshold, they are effectively forced to sell that stock, whereas you as an individual investor can keep it. Why would you want to sell your winners after all? I also think that this argument from Berkshire Hathaway is also a really good one.
Mr. Buffett, you've said that you could return 50% per annum if you were managing a $1 million portfolio.
One way or another, I can assure you, if Charlie was working with $1 million or I was working with $1 million, we would find a way to make that with essentially no risk, not using a lot of leverage or anything of the sort. But you change the 1 million to 100 million, and that 50 goes down like a rock.
Number 3, the size of your portfolio. If you have a smaller portfolio, and I'm assuming you do if you're watching this video not in the billions, then it's a massive advantage to have a smaller portfolio. If you have a large portfolio on the scale of hedge funds, then any buy or sell can actually move the market whilst you're doing it due to a lack of liquidity. For example, if you have 100 billion in your hedge fund and you like the sound of Ulta Beauty, it's got a 20 billion market cap and you want to invest a certain amount into it. So let's say you want to invest $5 billion, 5% of your total fund. And the total market cap is 20 billion. So you're effectively buying 25% of the company. If news of that happens, or even just buying on the open market occurs, you cause the price of that asset to go up massively whilst you're buying it, which means you have to buy it for a more expensive price than it was originally. That limits you to buying much larger cap stocks and only being able to put small percentages of your portfolio into stocks that you like. As an individual investor, you can invest any amount in. Warren Buffett has famously said that if he had a portfolio of only $1 million, he'd be able to make a return of at least 50% per year. And I believe him because he's done it before back in the 60s.
If you have a temperament that when others are fearful, you're going to get scared yourself. You are not going to make a lot of money in securities over time in all probability. If they buy a stock and they think if it goes up, it's wonderful, and if it goes down, it's bad. We think just the opposite. When it goes down, we love it because we'll buy more, and if it goes up, it kills us to buy more.
Number 4. This ties into reason number 1 a bit, but I think it's worth repeating again. If the market is in a fearful state and everyone's selling out the market, active funds are forced to sell their holdings because their investors are withdrawing their monies from the funds, so they have to sell their shares. Whereas you, as an individual investor, can be greedy when the market is fearful and be buying all of those stocks when they're at their bottoms. That means you can massively outperform the average of the market. When the market is conversely high, you can be selling your funds, whereas the active funds have much more money put into them, which means that they're forced to buy at the top. That is a massive factor in how you can beat the market, whereas active funds and hedge funds can't.
Better than average in investing over a long period of time. And obviously, Charlie is one of those people. So would I pay him? Sure. But would I take financial advisors as a group and pay them 1% with the idea that they would deliver results to me that were better than the S&P 500 by 1%, and thereby leave me breaking even against what I could have done on my own? There's very few. So
the 5th and final reason how you can beat the hedge funds and the market at the same time is because they have ridiculous fees. Think about it. All of those highly paid money managers don't come for free. The funds have to pay them, and in order to do that, they charge a ridiculous fee for having your funds in their fund. It can be 1 to 2%, and some hedge funds charge 20% of all of your profits that they make you in a year. That's a crazy amount. If you look at yourself when you're individually investing, you don't charge yourself any fee, and you're probably not giving yourself a wage from the profits that you're making. You can also use a low-cost platform which gives you no trading fees and has no management fees, and that will leave you well on track to beat the market. Some of these actively managed funds may be giving the same returns as the S&P 500 over a long period of time, but minus the fees, it will be significantly less, especially when compounded over a period of decades. Don't get me wrong, I'm all for investing into low-cost ETFs, dollar cost averaging into them. It's really simple and easy to do, and you don't even have to worry about analyzing them. I would encourage anyone that doesn't have very much time to research individual stocks, or anyone who has no experience with investing really, to just buy S&P 500 ETFs, buy them and forget about them. But I do think there's something to be said about investing into what you perceive as undervalued stocks, using a Warren Buffett type strategy. I do think that as the rise of passive investing causes money to just go blindly into whatever stocks are in the S&P 500 or otherwise, that there will be more opportunities for active investors to exploit inefficiencies in the market and get better returns than what you can get with a passive investing strategy. So I really hope this video convinced you of an active investing approach, and if you did make it this far, please give me a like and subscribe, and I'll see you guys next time.